So everyone has seen your formal bios that are on your web pages, but it would be great if you could share some color about what's not on there, how you came to the decision to do a search fund. We'll start with that. How did you come to the decision to do a search fund?
So first of all, my name is Chris Miller. I'm with a company called Trumpet Ventures, and so my partner and I are 2000 Stanford grads. Lanny Fritz in the audience, thank you very much. We've been thinking about doing this really since 2000, since we graduated from the GSB. For various reasons, we haven't gotten it done until 2008. Lanny and I have we graduated from here and went our separate paths. Mine was in venture and then eventually entrepreneurship. Spent the last 3 years kind of running a healthcare services business. And Lanny, kind of a pure operating background, went to work for a company called Savvy Technologies that was bought up by Lockheed, and he ran a division for them. And for various reasons, like I said, we couldn't figure out a way to do this together. The magic sort of came together this past summer when I had the chance to leave my company and Lanny had the chance to leave his, and so we raised a search fund. So we're a bit, I guess, older than and maybe a bit more experienced than typical searchers, but had been wanting to do this together, and I guess this was our chance to kind of be able to name our board and get a little bit of a bigger piece of the pie. So better late than never, I guess.
Throw in a little color. You said when you raised the fund, you talked for everyone else. You talked about doing it with a partner if you chose to do it by yourself or partner. And when you raised it, if you had specific focus, geographic, industry.
Yeah. So good question too. Given our backgrounds and given the fact that I was in healthcare and my partner was in specialized logistics, we raised this with a specific industry focus on those two industries. So the object is to find a business in healthcare services or specialized logistics. That said, we're still willing to be opportunistic if we find the right deal outside of those spaces, but the bar is that much higher if in fact it is outside of those two industries.
Hi, I'm Ryan Robinson. I was a 2007 grad from the GSB and raised right after graduating, kind of started up in September after graduation and raised our search fund. So we've been at it a little over a year. We kind of closed our fund in November of 2000. And I guess I came to business school. I was working for a hedge fund before business school, and I came to business school knowing that I wanted to, or thinking that I wanted to start my own business. And when I got here and learned about the search fund model, I did a lot of thinking and realized that it wasn't necessarily starting the business that I was excited about, but actually managing a business. And the search fund seemed like a great way not only to quickly get to more managing than starting, but also to have a group of investors like the four people up here before in the previous panel who have a vested interest in you and have, provide a lot of experience and advice along the way. And so that's kind of how I got in there. I knew that I didn't want to do it by myself just because of the kind of person that I am. I like to have somebody in the room with me all the time, and I couldn't have done it alone. There's no way I could have done it. I mean, just having somebody there to bounce ideas off of, just to talk to during the day, that would kill me more than anything, just not being able to, have someone there. But most importantly, to have somebody, I think Lou was talking about, having somebody to really challenge you. And not only challenge you, but pick you up when you're down and bring you down when you're too high. There are definitely times where I'm really excited about a deal, and Lucas, my partner, will be like, you're crazy. This is never going to get done. He's never going to agree to any terms that we'll agree to. Or the opposite. I'm sick of looking at this industry, and he'll be like, this is such a great industry for this and this reason that you've told me. So I think for those reasons, I knew that a partnership was right for me. Were there any other questions that I missed?
That's good.
My name is Daniel Daum. I manage Wire Capital. I started the fund in 2006 after I graduated. It took about three months to raise the fund. And the reason I chose to do a search fund was I wanted to see business from start to finish. And I wanted to experience all the different aspects of it, from creating the investment memorandum and getting a sales pitch together to selling my ideas and my enthusiasm for this. And then once you actually purchase the business or finding the business, I wanted to manage the business and look at the strategy perspectives, look at HR perspectives. So I really wanted to dive into all the different aspects of business. And the search fund was right there at the top of my list. And actually, I heard it the first semester that I was here, and it never left the top of my mind. It was always there. So I'm very excited to do it and fortunate for the opportunity to do that. And also jump in real quick and say that I'd like to thank the CES and the professors here who've been so supportive and to create events like these to help the searchers out and promote this career opportunity. We're pretty lucky to be able to have that. And so with their help and resources, I was able to evaluate the search fund if it were for me, and find investors and some of the tools to use to help find companies. So I've been searching now for just about 30 months is where I'm at right now. So there's been a lot of ups and downs. I am a solo searcher, and so I also like to mention that it's true. It can be an emotional roller coaster at times. If you do a solo search, it's very important to have some other entrepreneurs that you can talk to who have been through failed deals or failed pitches, and those who've raised money and been through that. So it is very important to have a support system. If you don't have that, it'll be very difficult.
Name is Chris Hendricksen. Blue Canyon Capital was our search fund. I did it with a partner, Andy Schoonover. I was also in Dan's class, so class of 2006 from the GSB. We raised our fund right after graduation, started up operations in about September, and closed our deal about 13 months later in October of 2007. We bought a company called VRI that does healthcare services for the elderly and people with disabilities, like in-home health monitoring. You'll think of Help, I've Fallen and I Can't Get Up. We do stuff like that, but a few other things as well. Our search was nationwide. We were industry driven. I wouldn't say we had any particular industry expertise, so we were industry focused, but more like Lou and Jim talked about, where you pick 6 or 8 and you just kind of bang through them as hard as you can for as long as you can until you can find a deal. The reason I got into it was basically I came back to business school after a pretty typical finance background, investment banking, private equity, and in my private equity life, I got dumped into a company that was just getting killed by the industry that they were in, and I didn't know how to do anything. I kind of realized I don't know how to sell, I don't know how to do HR, I don't know how to do a lot of the day-to-day, so I'm going to go to business school and see if I can figure out how to do it. And when I got here, I realized I want to go back and actually do that stuff now because I really enjoyed it and I feel a little more equipped. And so I did a startup internet kind of consumer technology stuff between first and second year and realized I stink at technology and I don't like 0 to 1 million. I don't like the startup thing. So the search fund just fit perfectly. This is a real business. This is something I can understand. It's nuts and bolts. And so it was perfect for me, and I had met a partner that I thought would be a great partner for me in terms of complementary skills, and he was excited about doing it too, so we took off and got into it and had a great experience, and now we're living the day-to-day of just knocking it out in a small company environment, and so happy to talk about that as well.
In Dayton, Ohio.
In Dayton, Ohio. Looks a lot like what it looks like out here, except about 30 degrees colder.
So I'm going to address a few questions to the 3 searchers, and then we'll address some questions to Chris on the operator side. So we heard from the investors what their take is on the small to mid-market M&A, small to mid-cap M&A market, but you guys are calling these companies all day, every day. So I'd love to get your impressions on the quality of assets you're seeing, seller expectations, and how you're addressing these, how you're contacting them, and any changes you've made in your strategy based on economic changes in the last 3 to 6 months.
I'll take a crack. So I think the good news here is that we've seen a significant increase in the deal flow we're seeing now. I don't know if that's consistent across the board, but
For what time frame?
it's really started picking up mid-January, so 2009. The last month and a half have been really good for us in terms of deal flow. I think that's really a result of probably a couple of things. First is just general fruits of our labor. We worked really hard the first 4 to 6 months to kind of build that foundation and make sure we reached out to every possible deal source that we could, from private equity firms to bankers to not really so much brokers. We haven't found those to be as useful as others have, but friends and family. We've seen deals come from a number of different sources, and those are starting to pay off. So we're seeing some good deals that we're really excited about over the last 6 weeks or so. And in terms of expectations, I think that was the other question. We've seen a little bit of a drop, I think, in terms of seller expectations. Not drastic, but like I said, we're digging into 2 industries primarily, logistics and healthcare, and the healthcare industry really hasn't fallen hasn't tapered off in terms of expectations as we would have liked. We've seen a few good deals, and those are the ones we're really excited about, and we've got a signed LOI on a company right now. But in general, I think expectations from sellers are dropping, and we're now incorporating language and talks about seller notes and earnouts, on widespread fashion. So that's commonplace now.
I mean, I would agree that deal flow has picked up since January. I mean, just kind of looking at the last year, deal flow over the summer started drying up, and then kind of August, September, we started realizing that most of the deals we were seeing were pretty garbage. And then October, November, it seemed like we weren't even seeing as many garbage deals as we thought we were seeing before. And so I think that it's definitely, it's turned, and we're starting to see a little bit more. That being said, I think more than anything, what the change in the economy has done to our expectations is that we've really raised the bar in terms of the types of businesses we're going to look at. And because of that, we're just really not seeing much deal flow at all. And I think when you look at the good businesses that are out there, I remember, I think a couple of people said it in the last panel, Lou especially hammered it home, where if you have a good business right now, you don't want to sell unless you have to. So, I mean, to a large extent, we feel like we're coming into work every day trying to call the one owner who's invested in a lot of Florida real estate and has to sell, or the guy with the health problem. I mean, sometimes we feel like that's who we're really looking for, is the guy who has to sell for some reason, because the people that don't have to sell because of some other reason are selling because, well, most of the people we've seen are trying to jump off a sinking ship. And those are the people whose seller expectations have changed the most. I mean, we had one deal where we kept hammering them on terms, and every time we'd come back to them with a lower price, they'd say, well, deal. And then we'd say, oh, I know we said seller debt was going to have to be about, 2 turns. We're looking at like 3 now. Deal. I mean, anything we brought to them, they were going to accept it. And that's when, we were already starting to get squeamish about it, but
Run.
Yeah, we jumped off that pretty quickly. Thank goodness. But the flip side of that is good businesses that we're looking at. Public comps were kind of one industry in particular. Public comps were trading in mid-teens, and private comps were like, high single digits, maybe 10, 11. And we talked to one seller who said, yeah, I know back in 6 months ago I would have gotten kind of 7 to 10 times for this business, and now the public comps are trading 6 or 7 times. But to be honest, I'm still expecting 7 to 10 times for this business. And that's really what we're seeing more than anything with the really good businesses out there, the ones that we're targeting. So while, their expectations for how much seller debt they're going to give have drastically changed, and multiples have come down a little bit, I think for the really good businesses, for the bad businesses, multiples have come down a lot. For the really good businesses, they really haven't come down that much.
It's a very fair statement. And it's true that you do see sellers being more flexible on debt. That's for sure. The prices for businesses seem to be a little sticky, kind of like gas prices. The price of oil might fall, but they're going to hold those gas prices. The gas station's there for a while, and then they might come down. So I think we're in that little part right now where they're starting to come down a little bit. And it's very true. If a seller is not motivated and is pulling in significant cash flow year after year, he has no reason to give up that cash flow. And if he does give up that cash flow and receive money for his business, what is he going to do with that business? What is he going to do with that cash? So we as search funders have to identify pain points for these sellers, and that's as any good salesperson would do. You go out into the market and you find where your pain points are for your customers, and then you alleviate that pain point. The pain point that we're trying to solve at the moment now, which has developed a little bit at the moment now, is finding those folks that are pushed into the market when they might not have normally been doing that, and a little while before. So, we as sellers have to, we as search funders have to find those pain points, and it's our job to go through a structured sales process to find those folks. One interesting thing that I've noticed while I'm searching is that you get a lot of different books, either from brokers or you talk to owners, and you see a couple bad quarters in there. And it can be very difficult to distinguish between the systematic risk that we've seen over the past few months and the company-specific risk. So is this company is it just a blip? And it's going to, supposing when the recession, we emerge from the recession, this company will take off, and that'll be great. Or is this company really just headed down the drain? And that's one thing that's taken me the most time during my daily activities is really trying to find out what are the other companies in this market doing. Trying to find river guides or other CEOs and talk to those CEOs. GSB Network has been fantastic for that. And say, well, I've talked to a company and their sales have decreased 10% last quarter. How does that match up with sales that you've seen and friends that you've talked to in the industry? And they might give you some data points. So it's changed a little bit from saying, okay, let's just evaluate this company and then, okay, I think I can change EBITDA here, raise sales by doing this. Now it's a little bit more of, okay, is this on a downward slope that we're not going to turn around, or is this just a quick systematic thing that's attributed to the economy? So that's one thing that I've really focused a lot of time on since the economy has changed.
Great. So let's talk about debt. Have any of you found the elusive senior lender? Had conversations specific with mezzanine lenders. We didn't talk about that in the last panel. And Chris, you can maybe also address if you raised financing when you did your acquisition and what that relationship is like with your lenders.
Sure.
Yeah, I thought I'd heard some rumbling about the commercial lender market loosening a little bit, but after that last panel, I'm going to forget it. That's not true at all. So our strategy may have changed a little bit, but we have some good investors behind our fund, and there has been some talk about introduction to some commercial lenders that may be helpful and may be interested in services businesses, but we haven't yet started down that path. We need to soon, and we will do that. But I think probably what you heard on the last panel is true.
Yeah, to start, I wish that I had more data points on what lenders are doing, but we haven't had enough deals recently that we've gotten to that point. But the last time we went out looking for debt, it was going to be a cash flow lending, and we could only find mezz debt, and it seemed like they were solving for kind of mid to high 20s returns, which felt like a big slap in the face. And I think what you're going to come back to is what was said on the last panel, and Chris alluded to. You're either going to look at, call it all equity deals, but where you're kind of providing a mix of sub debt and equity for the same group of investors, and then you're pushing for as much seller paper as possible. I think there are people who have found senior debt, but it's more the exception than the rule, and you kind of have to be in that right situation where some bank in Dayton really wants to have more healthcare exposure and is willing to kind of put it out there. Other than that, I think it's really tough from what we've seen.
From what I've seen in the bankers that I've spoken with, is the senior lenders are willing to lend on assets. So if you have a lot of stable collateral, you could probably get some financing done. When it comes to, and for larger companies as well, over $3 million in EBITDA. But when it comes to cash flow lending, the senior lender is not going to touch it. And mezz debt's out there. The rates that I've seen are between 12 and 18%. For interest rates, and then a lot of them do want some warrants as well. So they're certainly solving for low 20s for their returns. So if you're going to look at cash flow lending, then the mezz debt's probably the way to go these days. But be aware that it's all over the place. So I think it's very important to shop around.
I think things have changed quite a bit. I think we got pretty lucky in terms of our timing. We closed our deal in October of 2007. Our deal was. Our multiple was kind of between 5 and 6 times total purchase price, and we're a little more than 50% debt. So, all cash flow deal in the 3 times plus turns, and it's all senior. So that deal is not available today. I talk to my banker pretty often, and he's very clear about that deal is not available today, and so that we got a little bit lucky. The market was probably starting to turn a little bit when we did our deal. And I think has slowly marched its way down from, those kinds of terms to 2 times to 1.5 to 0. Now I think there's just no way to get any money. Our relationship with a bank has been pretty good because our business is hanging in there. It's a healthcare business, so we're not quite as affected by the economy. But my take of the general, conference room in a middle market lending bank right now is a lot of people talking about why this deal's going down the drain and what are we going to do to pull it out. And what do you mean you got a new deal? Do you want to show me we're not doing any new deals if there's not assets, or it's not fully guaranteed, or there's not cash collateral? And so my take is the senior market's pretty much closed, and our strategy as someone who has a senior debt piece is put your head down, run the business, and when the market changes, we'll come talk to you, and we'll hope, we've performed while the market was bad, so now we can talk about what the market looks like and what we can do. But for now, we just assume that they're a one-way street. Money comes in, but no money goes out.
And Chris, I'll let you keep talking a little bit. You're 18 months or so into running the business, and what it's been like versus when you decided to raise a search fund, what your expectations were, especially in light of the quantum shift in the economic climate.
Sure. I'll talk a little bit about just the expectations and then I guess the economic impact. But, we've been in the business about 14, 15 months now. I think the things we expected to like and really be excited about, the day-to-day management and the grind of, finding great employees and selling great new products to your customers and just learning the business for 6 months, because you show up the first day and everybody says, what should we do? And you say, I don't really know what you're talking about. I don't know anyone in the company yet. That's been really fun. I think we've really found that to be exciting and an energizing experience, and definitely not bored. I mean, there's definitely just so much to do. I think the things that shock you probably a little bit from the experience, things happen slow. Someone made the comment earlier, know your workforce, know who you're going to have as your team. We have a great team, a great group of employees, but they're not necessarily all like you or all the same type of energy or determination or drive. This may not be their 80-hour-a-week job. This is their 40-hour-a-week job, and so sometimes things get done a little slower than you'd like. Spend a lot less time on strategy and business planning than you do on blocking and tackling, and that's, I think, a good thing if you enjoy it, but it's something you got to know going in. And then I think you spend a lot more time on hiring and firing and HR than I probably even more than I expected. I thought it's basically a managing growing enterprises class. I mean, you just do it for real. You don't, Jim or Irv doesn't just say, hey, what would you do here? You actually do it, and then I hope that was right and see what happens. And so it's been a great experience so far, I think. And my partner and I, Andy, has kind of taken more of the Mr. Outside role, and I've taken more Mr. Inside role, so I end up doing a lot of operations, customer service, finance, that type of thing, and we've sort of paired that to our skill set. In terms of the economy and like what's happened and things have changed, we're in healthcare, so thankfully our business is still doing well and we're still growing, so we haven't had the massive changes in having to lay off people or do anything drastic to the business. The two big changes for us have been we're a lot more short-term focused just to be sure that things aren't changing. So we're running the business for long-term, but we're watching the business very short-term. And second is we are considering only doing projects that we can finance ourselves. I mean, back to the bank things. We're not looking at anything where we need capital or we need to raise money or we need to do an acquisition. I mean, we're just basically saying turn inside, grow the business, service our customers as well as we can, and try to keep growing. Great.
So Daniel and Ryan are, I guess you qualify as experienced searchers at this point. You're newer. But how has your day-to-day activity changed over the months and years, in your case, Dan, that you've been searching? What have you learned and how's that changed? And are there things that you wish you had done from day one that you're now doing?
Things have changed, not significantly. Things have changed in the sense that right now, as I mentioned before, you're really trying to analyze the systematic versus company-specific risk. We're trying to find river guides to evaluate the assumptions that you previously had. So you can, a year ago I had an assumption about, say, logistics or something like that. It's time to reevaluate that assumption now, given the current market, and talk to some more folks in that market and make sure that those assumptions are still valid. The unique proposition that we offer to sellers, that's pretty much the same. We have capital available. We give them a great exit strategy. It's a unique offer that a search funder can do, and it can be very flexible in the terms that you give the seller as well, whether it's to have them, like you did, Chris, have them stay on the business or have them move along, whatever they choose. So those things are very, very similar. one thing that I wish I would have done very early on that I didn't do until a few months later was be very, very rigid in the way that I measured my results. I didn't implement a CRM system, and one of my investors had suggested that, and that's one thing that right after he said it, I said, that makes complete sense, and I'm going to do it immediately. So I implemented that, and it was very helpful. It helps me measure my results. It gives me a benchmark, and also gives me an opportunity to look back and see what deals came through and reflect on why I let them go or why I pursued them. So that's one thing that, as a search funder, that it has evolved from the start to the finish is implementing that system and being, I kept track of things. It was a little bit in an Excel spreadsheet for some things. QuickBooks was great, and that was fine for all the finances, and that started from the beginning. But I wasn't, like you guys, an Excel guru, so we can pretty much do a lot of different things and database functions in Excel. But I really think that the CRM system was one thing that's evolved from the beginning of the search. When it comes to reaching out to sellers, like Jim mentioned, there's a lot of different ways and mixes that people do, whether it's, I'm going to be focused on 100% cold calling, I'm going to be focused on 100% direct mail, I'm going to use a certain percentage of brokers, deal flow. That shifts back and forth every once in a while. If the cold calls don't seem to be generating a great amount of deal flow or quality deal flow, I might focus on hammering the phones more on brokers and seeing what they've got. It doesn't mean that they're disregarded at certain times. It just means you kind of shift your mix, and it's where you turn your head to. So those are the things that have evolved in the search fund, and a lot of things have stayed the same.
One thing that Dan mentioned that really struck home was kind of creating more process. And when you really think about this, it's a binary outcome for the three of us. Chris has already succeeded in that. Exactly. You either buy our company or you don't, and then it's either good or it's not. But start with you either buy one or you don't. And so it's really hard to track your progress on a day-to-day basis. You called these people, or you sent this email, or you did this research. Like, how do you have any idea whether that's gotten you any closer to buying a business? You really don't. And so what my partner Lucas and I have tried to do more than anything, and it's very evident when I look at kind of our day-to-day now as opposed to our day-to-day when we started out, is we put as much kind of process and rigor and accountability in place as we could. And, the two of us were good friends going into this, and so accountability was something that was a little hard for us because, if he didn't do something, I was like, he's my buddy, I'm going to let him slide. But we really can't. When we realized that we had to treat each other more as almost each other's employee when it came to holding accountability than we could, being partners. And so that's kind of one of the things we put in place. And we also just implemented Salesforce, which I think all of you guys, if you start a search fund, and the young pups in the search fund world are all doing, but it took us a while to come around to it. But I think that, and then from kind of what am I doing on a daily basis, how's that changed? Lucas and I we're both opportunistic and industry search, so we'll look at any deals that brokers bring us, but we're also kind of picking our industries, like Chris mentioned, kind of your 6 or 8 industries, and just kind of hammering in and running through one after another. And last year, we kind of think the ideal mix is 50-50 for our opportunistic versus our industry time spent. And last year, we were definitely 70-30, weighed more towards the opportunistic side. And this year, it's kind of swung back in the other direction, where I think we're seeing less kind of quality deal flow from the intermediaries that we're dealing with. And so we're focusing a lot more on digging in our industries and just making as much calls as we can and really digging in. And I guess that's the last thing, is just the amount of cold calling that we're doing. And that might be a function of kind of focusing more on the industries as opposed to opportunistic deals. But I think we were very tentative at first to really get on the phone without already being an expert in an industry, to get on the phone and try and talk to the CEO and convince him that he should sell his business to you. And now I think we feel a lot more comfortable, as long as you know enough about the industry to kind of talk the talk, that you start digging in, start making cold calls, and that's really how you become an expert, more than finding that 12th research report on Hoovers.
Do you mind if I chime in,
Love
even
it.
as a newbie?
Love it, the newbie.
So we just finished our 7th month, and our process has changed a little bit. But I'd say there are 3 things that are kind of critical doing day to day in this, especially in this environment. And the first is, like these guys have said, you need to run this like it's a business. I mean, you really need to hold yourselves accountable, set milestones, and stick to them. Set goals and continue to track your progress. But second, I'd say it's also useful to get your investors in the loop early. You may have some investors now that are more cautious than they had been in the past, and you want to find out if they're going to kill a deal or not like a deal, and you don't want to waste time. So as soon as you start traveling down the path of digging into a company and doing the diligence on that business, even before you have an IOI or an LOI, I would get investors involved and get some feedback early in the process now. And third, I wouldn't waste time with sellers in 2 respects. Number one, when talking to a seller, I'd find out if they want to sell that business in the first phone call if you can. So in cold calling that company, there's no beating around the bush and trying to find more about the industry. I'd find out right away if they want to sell that business. And second, when you do have an interested seller on the line or in a meeting, I'd find out the number they're looking for as soon as you possibly can so you avoid wasting time and make sure your expectations are aligned. And we made the mistake of taking a trip down to New Mexico to hunt for a company that we thought we'd listened to an advisor on the numbers, and we thought we had an idea for what they wanted in terms of revenue and what they had done in terms of revenue and what their expectations were in terms of enterprise value, and they're way off. So we learned quickly, in the next businesses we looked at, we're going to find a number, in the first conversation, and we did that with this company we have an LOI on now, and we talked the numbers before we even signed that LOI, and now it's not an issue. So.
What point are you addressing the seller financing, and how much education are you doing with the sellers on what that is, what it could look like?
Yeah, and it's across the board. The company we chased down in New Mexico, the seller didn't know EBITDA from revenue, and it was a complete education process, and we didn't even get to educate him, unfortunately. But this seller we're talking to now has done a nice job. He's not a businessman, but he's done a nice job of educating himself and understands what his company is worth. He has realistic expectations, and it was kind of in the 4 to 6 range, and understood that he coming into this that he'd probably have to take an earn-out and utilize the seller's note. So that wasn't a surprise to him, and fortunately didn't take much education. But it's across the board, depending on what you find.
You want to chime in on seller financing?
I think Chris really nailed it, where it's the sooner you can talk about a lot of these things, the better off you are. I mean, one thing that we all feel, hanging over us at all times is that we have a finite amount of time that we've raised a search for, and time is pretty much our most precious commodity. So that to the extent that you can not waste that time and do whatever you can to be most efficient with that time, you need to do it. And so I think that goes to kind of talking about things as soon as possible. That said, you can't put the cart before the horse, and you can't start talking about how much seller financing you're going to put in before he even knows that you're in the ballpark of what he wants in terms of valuation. So I don't know. I mean, I think it's kind of a fine line, after your couple of calls and maybe you've met the person, then you start really nailing out kind of those second or third order terms of what an agreement can look like.
I'm just going to add one thing. I think if you're in a situation where there's a hard decision or a hard conversation you have to have with a seller, this is the kind of time where you have to have it and not waste a bunch of time diligencing the business and meeting and doing all this stuff and talking to banks if you have to still have that conversation. So if it's seller financing, if it's a purchase price reduction, if it's, hey, I need you to leave the business in 6 months, whatever it is that is important to you and you're going to ask for at day 60, ask for it at day 6 instead of waiting until you wasted all that time and all your effort, because that's all you have as a searcher is time and your own time and dollars that are slowly running out as it's a little wick burning into your cannonball that explodes if you run out of time. So don't waste it, on a deal that's not going to get done.
Great. I'm going to open it up to questions, and then I'll wrap up with one last question. Matthew.
Daniel, can you talk a bit more about your decision to go with the search fund alone, and also can you talk about some of the challenges that you faced trying to do this alone and how you kind of mitigated some of these?
Sure.
I'm going to repeat questions for video. Question for Dan, who did his search fund solo, and the decision behind that, some of the issues he's had, and how he's tried to mitigate those issues.
When I decided to do the search fund, I had these two guys, Chris and Andy. They were I think you guys were starting to do a search fund pretty early. I think you guys started raising before I did. I was the third person in my class to decide to do a search fund before graduation, and I started actually raising money before I graduated. And so I was the third guy. I did have some folks from college that I spoke with about this. They weren't that excited about searching for a company and then moving wherever it was. I think at the time that's just how it worked out. I would have been definitely amenable to having a partner. It just happened that it just didn't materialize. I did talk to some folks, and it's kind of funny though. A lot of my classmates went out into the workforce from the 2006 class. Went out to the workforce, and 2 years later they're now back doing a search fund. So there's quite a few of those guys out there. So that's kind of just how it worked out. I was certainly open to having a partner. I talked to quite a few people about doing it together, but it ended up that I just ended up doing it solo. I started raising money, and it just kind of snowballed before a final partner decision was made. And mitigating the different, emotional roller coaster, as I mentioned before, of a search fund. I mentioned it's very important to have a good support system. Fortunate that my the GSB network has been great, and there's quite a few entrepreneurs from my class who are around the Bay Area, and I keep in touch with them frequently. We discuss each other's businesses. We talk about one of them's in the very early startup stages. One of them's a little bit later. So we talk about all these different issues. I run business ideas by them. They give me quick feedback of and kind of play the role of what would an investor say. Play devil's advocate, and so that's really helpful. And to have that support system, I'm very lucky. My wife's very supportive. That's very helpful. And believe me, this goes for any entrepreneur out there. If you're going to take on this undertaking of either a search fund or an entrepreneurship path, make sure that your spouse is on board with this, because it could be a long process. Your wife might end up joining you in Dayton, Ohio.
She's still in Columbus, but she'll be in Dayton.
All right. That's what I'm saying.
She's working her way there.
That's right. You need to get your make sure there's a plan out there that you can see together, and that's very important. So it's just about having a support network. Talking to other search funders is another thing that's very important, and we kind of bounce ideas off each other. So I think that's and it's not just an emotional thing too. It's also intellectual, like you said, to challenge each other. With you and Lucas, with your assumptions and industries to do that. So
Coley, who gets accolades for recruiting all these gentlemen to be on the panel. You're up.
Questions for you, Chris. Can you just talk a little about, if it wasn't obvious to you and your partner when you were going into the search about how you guys would do things differently once you got into the company? Maybe it was, I don't know. But if it wasn't, could you talk a little about how you went through that process, how you figured out who would be sort of outward, inward, what you mentioned, how things have fallen out today?
I think our personalities and our roles were a little bit obvious. It's actually a question you'll get if you do a search fund from like every investor is, well, who's going to do what if you're partners? And it's almost an impossible question to answer if you don't have a real company. I mean, what are you going to do if you two guys buy a business? Well, depends what the business is. So I think we had a pretty early feel that Andy was more, he's a blue sky, optimism, driving, sales type of person, and he believes it can happen and it will happen, and it does. And so that fits his role more. I'm risk mitigator, details, analyze, so I'm the operations guy. When we bought the business, then we had to sit down and say, okay, now we have a real business. What does that mean? What's outside and inside? And so we did have to make a couple trade-offs of, inside at one point there were 4 salespeople and 50 employees, so it was 46 people and 4 people. That wasn't going to work because I was not ready to take 46 people on as the manager. So, we did divide up certain things and say, okay, you take this. It's a little less day-to-day operations, and we'll kind of change things over time. So it was, I think our styles made it more obvious, but it wasn't because of specific, operational skills or experience or anything like that. It was just it was a feel thing, and we've tried to reevaluate it about every 3 or 6 months and say, hey, is this still the right mix. I mean, we have a pretty unique situation where the seller still is part of the business. He still owns a piece of the business. He still wants to work there. He still comes to work every day. He's great. We have a great relationship with him. So for at least 6 months or 9 months, we were basically standing next to him a lot of the time and saying, what do you think about this decision? This is what I would do. What would your experience say? And so for a while it was a little bit of a three-headed monster, and we've started to split it apart into being a little more comfortable with our roles.
Right. Sure.
Just want to pick up on you saying it's unique that you're partnering with the seller. Is that the case? And I'm just interested in the panel's thoughts on whether they would be prepared to partner with the seller, buying back in, or maybe there's two partners.
The question is, what relationship do you envision with the seller of the business?
So let me chime in. We hadn't envisioned a seller sort of being part of the business, and in my previous life when I ran this healthcare services business, we tried to keep the seller on for a while, and it just didn't work. And I think what most professors and business people will tell you, and I know Growth Spec is a big proponent of this, is to try to get the seller out as soon as you can, because it's a recipe for disaster. Now that said, we're looking at a business now where the seller is a great guy. We've gotten to know him very well. We get along with him well. He's a believer in what my partner and I can do to build the business, so he wants a big chunk of this business going forward, which is great because we know that means he believes in the business too. And he's also educated in this space where we're not as educated, so we need him to kind of manage some of the relationships, would need him to manage some of the relationships and move the business forward. So we're entertaining having him remain as part of the business, but it's something that we didn't expect kind of going into this.
I think it's definitely the exception to the rule is to keep the seller around. I think a lot of people sometimes try it, and most stories I've talked to, I mean, this was our concern going in. We really liked the guy. We have a great relationship with him, but you got to have a backup plan because 6 months in, he decides, no, I make the decisions. No, that's not how I want to do it. I don't like working with you guys, or you gave me a bunch of money. I want to go to the beach. Any of those things, you got to be ready to react. So I think you always have to have the parachute plan that the seller might end up leaving.
Yeah, and let me also add too that it needs to be at your option. So if we do this deal, which is still a ways off, but we would make sure that it's at our option. It's an option that we squeeze him out of the business. If in fact it doesn't work out. So we put an employment agreement in place and make sure that he understands that it's still us who controls the business, and that really needs to take place.
That's great.
I'm curious if you come across businesses where the operator, sort of the owner-operator, has something of a minority stake, and so the majority of the shares are from his investors, and how do you handle that? I mean, is there any way of having to sell his investors?
So the question is, have you run across deals where there's a diverse investor pool? It's not just the owner-entrepreneur that you're trying to buy it from.
I mean, we've come across. Have you come across that? We had one that was kind of pseudo like that. But.
Yeah, I've dealt with two that were like that, and they were all three. It was three investors who were owners of this company, and they all wanted to sell, and they were on board, and they were ready to go and move on. That was their thing. The other one, the investors, and I didn't talk to for the second example, I didn't talk to the other investors in the company. It was the CEO. Was going to manage that relationship with his investors, and from what I could read from the seller, I think that he did have commitment from all those there's two other investors to sell the business. So I think I never got to the process where I had to talk to every single investor. I had one point of contact with them.
Chris?
Can you tell us a bit about your fundraising experience? So who did you approach, and what were some of the secrets to success?
Question is on fundraising, who you talked to, and the secret sauce, how you raised your fund.
I did it in 2006. That was the secret. I always say I just split the investors into. I always try to tell new searchers split them into a couple different categories, which is there's people and people that know search funds. I never had success selling someone both things, selling myself and the search fund model at the same time. So our investors are all people that we've either worked with before or have relationships with, or that have done search funds before and fall into that search fund network. I think that Jim made a very good point in the first panel, which is when we were raising money, you get out there and the first few units you do should probably be people that you know, and then after that you go out and start meeting people and going, I hope these people will invest in my search fund. I hope I can get all this money. And you really got to be tough on who you take. I mean, these are people you're going to be working with for 10 years, maybe 15 years. I mean, this is long-term commitment. So be excited about being their partners for a long time. And we ended up with a mix of probably half and half. We have 20 investors, about half and half who were people that knew us, and then half people that were kind of search fund, the search fund network. I won't call them the search fund mafia.
I think that's right. I'd say finding a good mix is important. People that know you well and the typical search fund investors, because if you invest with just the search fund investors, they may kill a deal that you're excited about. So this gives you some other options. But I also think it's important now in raising a fund. I would be flexible, be very flexible. So if you're looking at raising a search fund now, I would not limit yourself to say a California search. I think that's just going to kill you quickly. So I'd be open geographically. I'd be open in terms of the terms of the raise. So I wouldn't come in demanding big terms from investors now. I wouldn't say I need a make-whole provision. Just sort of stay away, use the standard terms, be flexible, and try to find that good mix of investors.
I think just to quickly add to that, I mean, one of the most important things Chris mentioned is just people that you like working with, because you're going to be working with them a lot more than you think. And in our case, it's been a pleasant surprise how much contact we've had with our investors. But for us, we kind of had three big tent poles of people that we were looking for as investors. One big one was just people who could write big checks. I mean, like they said before, there aren't many search funds that every investor puts in their total allotment, and so you're going to need more dry powder to put to work. And I think more importantly are investors that add a lot in terms of industry and investing experience, and people you can turn to, whether it's Chris in a situation when he's running a business, or us in a situation where we're really trying to think through the valuation of a certain industry or trying to break down an industry. It's important to have people you can turn to for that. And then the third is just people with kind of a broad network of contacts. It's been great to kind of turn to our investors at different times when we needed to do due diligence in a certain area and have them put us in touch with key people and knowledgeable people in the space. That's kind of what we look for.
Let me add one more thing. The folks that call me, I definitely describe what Chris said about separating them into the four quadrants of people that know you and know search funds and that different classification. But one thing that I would recommend to those raising a search fund is that you want to be very specific and scientific about the way that you raise your fund. And it comes from a marketing perspective. And you want to look at the different milestones that you need to do to get this fund raised. You need to have your investment memorandum written and different examples of companies that you like. You need to get this in people's hands. You need certain phone conversations to happen. You need certain visits to happen. These are all different milestones that you need to track as you go out raising this fund. I took a class at Stanford that was Salesforce management, and that class was fantastic, I thought. And it was all about being very scientific about your sales process. And we did a simulation in that class, and I did the exact same thing when I was raising my money for the search fund. It was very transferable. So guide people down the sales process. You're tracking them to see where they are in the process, who you need to follow up with, and you should be fine.
Well,
given the comment in the previous panel about the importance of due diligence, what are some of the kind of best practices you've learned, and how much of the due diligence is personality due diligence, and how much of it is like document discovery?
the question is on the due diligence, Chris, that you did for your company, or what you guys are doing with LOIs. How are you going about it? How much is personality, so that with the owner or the people working there, versus hard facts, documents, financials?
I would say as much as you can get hard facts, get them, because a lot of small business owners kind of have a very idealized sense of their business and how it runs, is a nice way to put it. But I mean, we found in the due diligence processes that we've been in, knock on wood, thank goodness we didn't do any of the deals that we signed an LOI on to date. a lot of the key assumptions we went into the deal with, which were based on information that the seller had given us, including numbers that the seller, or percentages or margins or whatever it is that the seller threw out. When we really got the data behind that, they were completely false, and really kind of it all falls like a house of cards once that happens. And so, I think it makes sense to do personality. I mean, you want to buy business from a guy you like and the guy who you think runs his business the right way. But most important for us in the due diligence process has really been getting as much data and as much, hard numbers as we could to really make a proper decision.
Yeah, I would say the same in terms of if you're going to get a deal done, you need to have real diligence. I mean, you got to get real numbers, you got to get real documents, you got to go through it, and it's painful for most sellers. They're not ready for the exam that they're about to undergo, which is usually way more intense than they expect. The only personality or qualitative diligence I think I put a lot of weight on is the stuff the seller can't control. So when you go out in the industry, and if you know that industry and they have a good reputation, or other people are telling you how good their business is, and you see them in other places, I think that's a solid qualitative point. But other than that, I mean, if you're going and deciding if the seller is a good guy, I mean, we met a lot of businesses where the seller was a great person and tons of fun, and that's probably how they got lots of customers. And you get inside and you see the numbers, and you're like, this thing's gonna fall apart. I can't run the business this way, and so there's no way we're buying this thing. And the second piece I'd say is, as you're doing diligence, whatever you have a hard time getting diligence on is the things that are going to be hard to run in your business. So, we had hard times getting certain things, and those are the things I'm still working on 14 months later, and grinding out and working hard at. So what you see holes in when you diligence, you will work on when you get there. So be aware.
Jim has a question or comment. Jim Sutter.
Question for Chris. What was a big surprise, your biggest surprise that you didn't uncover in due diligence that you found out after you bought the company?
Our biggest surprise. We had a nice big tax surprise that came up right after closing. Thankfully, it was indemnified, so it was paid by the tax bill. Thankfully, it was paid by the seller, but that was a nice big. That I would say, go back to the conversation of does the seller stick around? That is a very hard conversation to have with the seller when it's not a seller, it's your partner. You owe me all this money to pay this bill. It was a hard thing to do, so be wary when someone's there that if you have earnouts or things like that and you have to go have hard discussions, they're not just this seller that lives in this house over there that you have to call their lawyer. It's their conversation. That was probably the biggest surprise in terms of diligence items. I think it's more was just we knew that some of the systems were pretty light, and so some of the financial systems and hiring and employment systems were light, and that's what we've worked on quite a bit. There haven't been any huge surprises or errors since then.
Good. One more question.
I was wondering, do the sellers you're talking to realize that you don't have committed capital? And assuming they do, how big of an issue is it for them that you can't offer the same certainty to close as a strategic or perhaps a private equity?
So the question is it an issue with potential sellers that you, as a search vendor, don't have committed capital? And how do you address that? Is it a disadvantage relative to strategic buyers or private equity buyers with committed funds?
Let me just say, the fact that you're searching for a deal in this climate sets you apart in the first place. There's a lot of people on the sidelines. So, we call owners and we call different deal sources, intermediaries, and tell them we're looking for a deal and we're hungry for a deal. That sets us apart, and people sometimes can't believe it. So that, first of all, I don't think they care where your capital comes from oftentimes. But in talking to sellers, it's easy to educate them. We tell them we've got a committed group of investors behind us, and really it hasn't been an issue so far. So, that's my personal experience. I don't know if you guys disagree.
Yeah, it's not something that we bring up, but oftentimes people ask, and we're very upfront with the fact that we call it kind of a semi-committed fund where investors have put up some capital, but we have to go back to them to get the deal done, and so we make no bones about the fact that we do have to go back and get their buy-offing and raise additional funds to do it. But we've done a few things. There was one deal where they were really concerned. It was recently, and so we went to a handful of our investors, and a couple wrote kind of comfort letters saying we're going to invest in this guy, and then a couple others offered to take calls from the seller. And so you can do certain things to kind of make them feel comfortable that you can get a deal done.
I was going to say, I think brokers are usually more worried than sellers. So if you get a broker that says, well, are you guys a pledge fund? Are you guys, not committed? And you get into that, you might as well just flush it, because you're never going to convince them that you can really get the money. I mean, sometimes it's just their mindset. But we usually try to dispel the rumor that private equity funds are so guaranteed to close. Like, the money's not in your bank account until they close the deal. If it's a good deal and it's what you say it is and you promise on these things, this deal will get done and we will get it financed just as easily as a private equity fund will. The things that are going to block this from getting done are missing numbers, not living up to what you said or we said we're going to do. And private equity funds don't close on deals all the time, not because they don't have the money, just because they don't want to. So
I'm going to ask the last question. So in the audience, there's a lot of potential searchers, people interested in the concept, thinking about doing it. So what are the couple key questions you think they really need to ask themselves as they're thinking about this, or any advice you have for them as they make this decision?
I'd say two things come to mind off the bat. Number one is, can I raise the right group of investors? Can I collect the right group of investors and build that kind of a team? As I look at this as a people business itself. So can I form the right group of investors behind me, the investors that have the pockets that will give me the advice, that kind of have a mix of the typical investors and some others that know me well. So that, number one, I'd ask yourself that question. Frankly, as I go out to raise a fund and you're not finding that you're able to raise the capital from those types of investors that you want, that may be a sign. I mean, we did a lot of strategic work and putting that investor list together, and we chased after some specific investors, and that's who we raised our fund from. And granted, it was a different time, but I'd approach it like that. And number two, I'd kind of ask yourself about the time horizon. So I wouldn't enter into this thinking this is a 3 to 5 year journey for you. Now I think times have changed more than ever, so I'd entered into this thinking, all right, I'm going to build a business and be there for the next 10 years and build a capital structure that works for 10 years. So ask yourself if you're ready for that kind of a commitment.
The biggest questions for me, I think, first off, is do you really know what you're getting yourself into? You can sit in the audience and look at Chris and be like, he's running a great business. I'm jealous of him right now, I'll be honest. But when you get into this, right now, I'll be honest, it's much more of a roller coaster than I ever thought it would be. I'm a lot more stressed out than I thought about it than I thought I would be. There are mornings where I wake up at 4 or 5 in the morning. And, I'm not like in cold sweats, but I'm up and I'm thinking about it. And that never happened to me in any other job I ever had. But you do things to know what you're getting yourself into. And then the next couple questions are, do you think you'd be good at it? And that's really, asking yourself, what are you good at? What can you do? What do you think you'll struggle with? And really being honest with that and thinking about whatever partner you might be with and say, does this person kind of help me fill those gaps? Or is he like an anchor that's going to bring me down, which, could be the case and was the case with one person I thought about doing a search fund with. And then the last question is, are you going to like it? Because I think if you don't like what you're doing, or at least envision yourself loving, when you get in Chris's shoes, then it's a hard road, and I don't think that you're really gonna be successful, or you're gonna keep at it if you don't love it.
Regarding this question, I would ask yourself, if there were other opportunities, would I still be interested in doing the search fund? If there were other opportunities that paid much better, would I still be interested in doing the search fund? I've gotten a lot of calls from folks who say, well, banking's not paying as much as it used to. I don't know if the bonuses will come out. Something about maybe I'll just do a search fund, or job market's not doing so hot. Maybe I'll just raise a search fund. That is the wrong reason to get into this. This is a commitment, like Chris said, about your time horizon is going to be really long. I've been doing this for about 2.5 years now. So do you envision yourself 2.5 years from now still looking for a business? Can you envision yourself doing that? Can you envision yourself seeing yourself looking for a business and still enjoying it, and still looking at the end game and looking forward and being ambitious about it? So I'd be very honest with yourself. If you're excited about that, if you're excited about those prospects, or you're excited about, like Lou mentioned, I think it was Lou that mentioned being a sergeant in the company, and not the general, where you're probably going to have to get your hands dirty, have some tough conversations with folks, be the one maybe who has to sign the paychecks or talk to customers and collect the money. So if that excites you and you really want to get involved in the business, day-to-day business, and also the strategy of the business, then go for it. That's great. It's a really fantastic career path. It's really exciting, but there's also a tremendous amount of uncertainty. So also evaluate yourself of how you handle uncertainty. Can you handle uncertainty and still look at the end goal and keep going?
I'll throw 3 out there. The first one is kind of a decide for yourself if you're going to do it by yourself or a partnership type thing. I'm a pretty heavy believer that there's not that many people you can be partners with. When I thought about doing this, I kind of had 3 people in mind. Andy was one of them. 2 of them didn't go to Stanford. They were just other people I'd worked with before. Take that really seriously. I think you really have to trust your partner. Can you disappear for a month? You could get sick, and they just do everything, or you trust them. I mean, that's the only way you get a lot out of it, I think, is that you can stand in front of them and say, I think you're making a really bad decision. But it's okay. You're partners. You're going to go through it together. You're going to walk through it together. I think that's a really valuable thing. If you go it by yourself, then you don't have to ask that question. Just live with yourself. It's easy, but then it has its own challenges, as Dan talked about. The 2 other ones I think about, just do you want to do this? We asked ourselves, what's the worst case scenario for us? What's the thing that can happen here, and can we live with it? So for us, it was we search for 2 years. We find a business right near the end. We run it into the ground over 5 or 6 years. That's the worst case. Can I live with that? Yeah, I can do that. I get a lot of experience. I can deal with that. I'll be okay. So, no, it's not what I want. It's not my goal. But I can live with it. And I think that's important because, a lot of searchers, you may find yourself right now, if some searchers bought businesses a year, 2, 3 years ago, they're finding themselves in some pretty tough positions right now. And that's the time you got to circle up and say, I got investors behind me. I got a partner. I got employees. I signed up for this. I got to be here for a while. So, can you live with that scenario? And then the last one is just, the GSB has a lot of great people. Top business schools have a lot of great people, and they're going to go all different directions. So picture yourself in 10 years. Do you see yourself in Dayton, Ohio, running a small business, grinding it out day to day, or does that just not enter your mind? I mean, you got to feel like you're going to be there 5 or 10 years from now and go, okay, can I see myself doing that? Am I going to be juiced about it and excited? And if you're not, I mean, the deal part is not glamorous. The search is, to me, by far the worst part of it. It's the hardest. These guys work really, really hard. And I don't want to go through it again. So see yourself as, the glamour part is not there. Where do you see yourself in 10 years? And can you actually picture yourself doing, a small business in some town you never wanted to live in and never knew about? And okay, here we are. Let's go for it.
I ran over my allotted time. Gentlemen, thank you for a great panel for coming in.
Thank you. Thanks,